Well, good morning. Tony Virtue speaking, Virtue and Partners with our regular monthly update. And I guess self-evidently things driven at the moment by this second wave of the virus in Melbourne and how wide did that spread. So even today the numbers weren't good, which is a setback. And I think we've got to be pretty realistic about this, that while this continues, the community will be subdued and investment markets will need to take this into consideration. Turning to the economics at the moment, well, one of the reasons that you're seeing such a subdued market, obviously, is what's effectively becoming deflation. The graph in front of you just shows that the childcare basically being paid by the government, rent numbers are down, travel is down almost to minimal. So for the first time in arguably 80 years. We had a net negative CPI of nearly 2% for the quarter. Now, what does that mean for investors? It means that $100 today could actually buy more in the future, if that makes any sense. So this is strange times, and we'll need to see if that rights itself or we move into a period now where there is no increase in pricing. Now, if that becomes the case, the positive for retirees, as an example, is that the cost of living will be going down, not up. The difficulty for investors, of course, is that it becomes harder and harder for investments to go up. APRA yesterday came out with some guidance on dividend policy. Now, this is important. And they've effectively limited primarily the four major banks to a 50% dividend payout ratio. Traditionally, banks have paid out 70 to 80%. So this would mean a reduction possibly of a third on their dividends. By guidance, CBA are out next week, which will be the largest of the banks with with their full years and with their end of year dividends. Market is anticipating $1 rather than $2, which would mean $3 for the year rather than $4. Again, fully franked. Putting this in context, nearly half of the dividends on the ASX 200 come from these four banks. So it is significant whether you own the banks directly, whether you own them via a managed fund. And we'll need to find ways to replenish the income streams that we need to live off. This is something that certainly the government's very aware of. And one of the ways that they'll manage this is through a lower forced drawdown for allocated pensions. It doesn't help you if you're still going to cover the electricity and the bills, but it does give more flexibility. Internally, we'll be spending a lot of time on cost reduction for clients. We'll be sitting down and being very clear about this. Now, one obvious way of reducing costs at the moment is mortgage rates. And we're doing a lot of fixing of interest rates now in the low twos. So those of you who do have mortgages, and some of you certainly in our community here, significant mortgages, we're going to sit down with you. It is the easiest way of saving money in this market. So, the bad news is the investment market's earnings are going to be reduced. The good news is that we can offset that with a lower cost of capital on borrowings, whether that is for residential mortgages, investment mortgages, margin lending, etc. there. I guess one of the upsides of something like this is that our terms of trade have held up. So iron ore exports have been good. Even our gold miners, as you'd expect at a time of difficulty, have done well. Overseas, the US market's sort of held up in spite of itself to some extent, driven mainly by those same six companies. It'll be very similar here in Australia with what we call the WAXes now, the WiseTechs, the Appens, the Afterpays, the Zeros. They don't look cheap. In many cases, they're not making much of a profit, and their actual directors are selling down their stock, which is a bit of a warning sign. So diversification is the key. Certainly, we're holding more cash than ever, and we want clients to be holding at least a year's cash in reserve just to ride out however this plays out. Look, that's enough for today. We're coming into reporting season. A lot of that we will do by Zoom or certainly give you as many options as we can rather than you coming in face to face. We're in good shape here. We're working hard, as you'd expect. We've upgraded the website, which has been excellent. It means you can book times online now with us. So that's enough for today. Tony Virtue, when experience pays.